Hi, everyone. Today, let's talk about how big tech became the place to be. Then we'll talk about how UBS is likely to take over Credit Suisse, and it may have already happened. And then, in case you forgot, the Fed is still likely to raise rates a quarter point. Then we'll go over the charts. Then we'll finish up with my positions going into Monday. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this every single day that the markets are open, as well as Sundays. So make sure you hit the bell so you don't miss out on any future episodes. Getting really close to 1K subscribers, so I'd really appreciate the support. Welcome to the Portfolio Bulletin. Let's get started. So in case you didn't notice, big tech outperformed massively over the last week. We'll take a look at that in the charts, but really it's becoming the new defensive against the bank crisis. And you can see here, XLK was up 6.3%, which was the market's best gainer for a section, 6.1% for communications, and then utilities did fairly well here at 4.1, followed by consumer discretionary at 3.6. Google and Meta gained 12.8 and 10% respectively. Amazon was up 10%, and Tesla did pretty well here at 7.6. So all the big names doing quite well. This seems like the place to be right now, and definitely a good area to trade going into the next week. Also, gold did really well here at 6%. Again, marking the hottest sectors for trading going into the next week. Speaking of banking crisis, it looks like UBS is going to take control of Credit Suisse. Both of these companies did not do well over the last week. Obviously, people are concerned about Credit Suisse, and UBS taking on their pretty poor balance sheet does not look good for them. UBS right now is about a $58 billion company. Credit Suisse is around $8 billion. Obviously, I don't think they're going to pay market price for that. I would guess that they would cut that at least in half, probably $1 a share or about $4 billion valuation. And who knows exactly what their balance sheet looks like. They've had some pretty tough times, and we've been talking about them for a while. And my guess is that it's not great. You can see here, Credit Suisse is losing about $11 billion a day in outflows, which is definitely not what you want to see. But if the company is taken over by a more stable, more successful bank, and maybe if it's run better, then we could see money flow back into Credit Suisse. They also mention that they have ongoing legal costs, which could cost a total of $2 billion. And they also mention here that UBS is seeking around $6 billion in guarantees from the government in order to do the purchase. So if you're buying a company that's about $4 billion in market cap at a $1 per share valuation, and then you get about $6 billion in guarantees, but then you have to pay $2 billion. You might actually make a little bit of money while stabilizing the financial system. But of course, I'm sure that there's things on this balance sheet that make it a little bit more difficult than just a couple of numbers here. But it would be good for us as traders if Credit Suisse was not pulling down the markets. Then moving over to Fed rates, once again, we have the FOMC this week, and it seems like they're going to do a quarter point hike. Despite all of the things going on and the lending facility that they just opened, as well as the balance sheet increases that we talked about last video, it definitely seems like this is a way for them to maintain their credibility. They've said they're going to do 25 basis points. They continue to message that, and it seems likely that that's going to happen still. And they actually mention that here in the article, saying that they have to do something, otherwise they're going to lose credibility. They want to do 25 basis points. They continue to message that. And if they do flip on that, that could be difficult for the Fed to maintain credibility going forward. Obviously, if they do another rate hike, that could make this banking crisis even worse, with multiple banks going bankrupt and potentially others needing big cash injections from bigger banks as well as the Fed lending facility just to stay afloat. Another 25 basis points could be difficult for those banks and potentially make new banks more likely to shutter their doors, again making this crisis a little bit worse potentially. And lastly here, they mention that there's still cuts expected for this year, and this is part of why tech is doing so well, not just because they're less affected by this banking crisis, but lower rates in the future does mean good stuff for tech and companies that are a little bit less profitable. Big tech obviously is super profitable, but they make more money when they can get more money on their balance sheet and get that ROI on a higher invested capital number. And speaking of rate hikes, let's look at the Fed futures here for just a moment. So 62% chance that we're getting 25 basis points. It's been as high as 75 to 80% during the trading day, and it does seem likely that we're going to get that 25 basis points. You can see here it was 85% the previous day, so it is stepping down here slightly, but I still think we're going to get 25 basis points. And then looking at May here, the most likely case is that we get a pause. And then looking to June here, you can see the most likely case based on the Fed futures is that we get a cut already in June. So keep in mind the fact that if the Fed does not follow through with what the Fed futures are pricing in, that could pull down tech in the future. They're benefiting right now from the potential of cuts and a banking crisis that doesn't really affect them nearly as much as the rest of the economy. But if this starts to switch here to where we're getting a pause here in June, maybe even more rate hikes in June into July, which looking at July here, you can see the highest probability is another cut down to 4.25 to 4.5. Which remember, this is what the markets are pricing in. So if this does change and it becomes less favorable to markets, that could be bad for tech and generally for equities. Moving over to the charts here, starting with the S&Ps on the monthly view, you can see here it's still a doji. So we threw a wick to some resistance, got rejection, threw a wick to support. We're still holding right in the middle on the 9-month EMA and VWAP. Basically right where we are, you can see this area of highest volume. Markets continue to sit in this area. If we do break below 38.26 here, basically at those previous lows that we just tested, then you can see how low the volume is until we get to that pre-COVID high, all the way down at 3380, probably 3300 back in this previous zone. You could even go as low here as 3250. Does seem like that's where the monthly view would find support if we do break down through these support levels and the 55 EMA, trading at 3880. Moving over to the 1 week view here, you can see this is what it looks like in a little bit closer detail. You can see this area of highest volume, super important. We've been here for multiple months now. This last week was pretty bullish. We did hold that level, did throw a little bit of a wick to the upside, but certainly could get a continuation next week. Momentum showing weakness here. If it does break down and we do break these levels, then we're looking at the 200 SMA on the weekly view, sitting down at 3730 as your next level of support, which does coincide with these previous lows going back to October of 22, as well as June and July. If those break down, then you're looking at this lower trend line, currently sitting at 3650, and we might throw a wick to these previous lows all the way down here at 3500, which does coincide with that longer term trend line. This is the one going back many, many years here, which is a very powerful trend line, and that is the one that we did bounce off of in October before we had a really substantial rally and then multiple rallies to follow. So keep in mind there's still some pretty strong support, even if the monthly view looks like we're going much, much lower. It's also worth noting how much volume that we had in this week. Looks like almost 20 billion here in volume compared to 12 billion the previous week, 11.3 billion, and then 9 billion going back to mid-February here. So lots of volume, and it was a positive candle. So that does support the idea that we could see a little bit of a bounce going into the next week. But remember, momentum is still stepping down pretty substantially. And if we don't get a nice push higher in the next week, we could see momentum push bearish, which if that does happen, then we could see something more like what we had here from mid-September into the end of October, where we had a push down, pretty bullish week, and then multiple weeks of downward price action to that more substantial bottom. So keep in mind a couple scenarios here that are worth watching. We already talked about downside levels, but to the upside, looks like 40.50 is probably where we would see the most resistance, and that makes a good price target to the upside as well. Moving over to the NASDAQ here on the weekly view, we talked about tech being extremely strong, and it's showing here. You can see big engulfing green candle. We're above resistance here. To the upside, looks like we're probably going to go retest the 144 week moving average up at 1350, 1360, somewhere in that area. That also coincides with this trend line that we were talking about in last week's video. Marks multiple tops and bottoms here through June, July, as well as August here. And it certainly wouldn't surprise me if we overthrew that to the more substantial trend line, sitting up at 13,500, 13,530 back in this previous zone. So probably going to hold this level, maybe throw a wick to that upper level. Either way here, the NASDAQ looks strong, momentum stepping in the bullish direction, RSI very bullish going into the next week. Moving over to the daily chart for the NASDAQ just for a moment here, I wanted to show the volume profile. You can see if we do come down, we're looking at that 3041 level, which has been pretty substantial. We got rejection here, which ended up being a pretty substantial down move. Then we pushed through that level really strongly, took out these previous lows here from the consolidation in February, touched that trend line just for a moment, and then quickly got rejection. Does seem like we just need a little bit of a recharge, probably back down to that 341 level, find some support, and then we can push through going up to that major trend line. which is currently sitting around 323.50 to 324 by the time that we get to that level. Looking at the MACD, looks bullish. RSI looks bullish. And you can see just how much volume was done over the last few weeks compared to many of the previous weeks, almost double each day. So it looks very bullish on tech going into the next week. Moving over to the Russell here, you can see we're at a critical level. We're at this major trend line, which marks multiple bottoms here going back to October of 22, June of 20, and then going all the way back here to February of 2016. It marks that bottom almost perfectly. And then multiple bottoms here in 2011 as well as 2010. So very, very powerful trend line. If it does break down here, though, the next trend line is much, much lower, all the way down here at 1450. Obviously, there will be a little bit of support at this previous low, sitting down at about 1660, 1650. So we could get a wick lower, wick these lows, and then find some support and then close above. That would be pretty sneaky here, but if it does close and push down really aggressively, there's not a lot of support here on the longer term charts for the Russell. You do have to be pretty careful making sure that we stay above this level. Otherwise, trade very carefully because this could move lower, because this could move much lower pretty fast. Looking at the Russell on the daily chart, you can see consolidation, high volume in the zone. Going back to the December lows here, does seem like it's holding at least a little bit. We did close on the lows, which is not generally what you would want to see. Looks kind of weak, but we do have a little bit of divergence here on RSI on the daily chart. Like I said, we have that 164 level going back to this previous low. That is the next area of support on the daily chart. But if this breaks down here, it's going to be probably $20 of downside before we find a really substantial support and potential for a bounce. Moving over to the Dow here on the weekly, we got a candle of indecision. Does look like we're going to move lower, though. We do have substantial support down here at 310, 311 in this zone. Probably would throw a wick to the downside here at the 200 SMA on the weekly, currently sitting at about 307. So if we do get to that 310, 311 level, expect a wick to tag that level of support to the lower. Usually when levels are this close together, you do have to go with the lower level. And you can see here last time we came into this zone, we actually overthrew it quite substantially before moving higher. Otherwise, momentum looks weak, RSI looks weak, but still slightly stronger than the Russell. Moving over to the Dow here on the daily chart. Again, this looks quite weak, pretty much closing on the lows. Area of consolidation, similar to the Russell here. Talked about it multiple times. We do have a gap down here at 310.85, right at that trend support on the weekly view. Would make sense to come down there, sweep those lows, fill the gap, potentially find some support in that zone. Zooming out here to look at volume, you can see that next area of highest volume sitting down at 306, 307, potentially in this area where we would find some support. So might push through that 311 area, come down to 306, 307 before we find some support. So right now, Dow looks a little bit weak. Similarly to the Russell, you can see we do have a little bit of ascending RSI here, so a little bit of divergence, but momentum is still weak and we're still below the SMA on RSI. So could go either way here. Just be patient on the Dow, similar to the Russell. Moving over to the ratios here, we have the NASDAQ divided by the S&Ps. Not much to say. We had a rocket ship out of this bull flag that we had, consolidated, broke out, moved much, much higher, very fast. We're at this previous high. Looking back here to August, we have the 144 EMA up here at 325. We're currently at 320. So potentially a little bit more upside, might find some rejection at this level. We're pretty extended, almost overbought here on the weekly view for this ratio, which does still have pretty decent significance here. You can see multiple lows ended up being substantial lows. And then we got the longer term bounce. We're above the trend line, moving higher here. Even if we get rejection, you would expect to find some support in here. And this ratio certainly could go much higher, back these previous highs up around 350 to 360. Maybe we tag this major trend line, marking these highs here up around 365, which would mark a pretty substantial outperformance here for tech, at least over the next couple of weeks. Moving over to the SPX divided by the M2 money supply, you can see here on this chart, we're not actually that close to the major downtrend line that we've been watching on the SPX or the SPY. We're actually quite a bit further away from that. We are testing this downward channel though. We did overthrow it. We did find a bounce. We are retesting the 21 and 55 EMAs here on the weekly chart. And this major resistance here at the 10.5%. If this does break through, then we're looking to this next previous high, about 3% higher than we are right now. Momentum still does look weak though. If we do push through that level, then we have about another 2.5% to the next major resistance, up around this 4.85 level. And we have the 200 SMA and 144 EMA sitting up there as resistance. Again, this is a classic example where you have trend lines very close together. You overthrow them, hit the deepest resistance, and then get rejection. If we get up here, you would expect to throw wicks through this major trend line to the upside before we find rejection. But right now, this up channel is still intact. We do have to respect it going into the next week. Moving over to the SPX divided by gold, big bearish candle, closed right at the lows, gap down, filled the gap, and then broke down further. We're at this previous low going back to June of 22. If this level breaks down, this ratio could go another $2 or so, meaning that gold is currently outperforming, and it could continue to do so for the next couple of weeks here. Lots of volume happening right now, bearish volume, and it does look like this ratio is going to go much lower. You can see low volume through this area, no major volume until we hit this major trend line down here, meaning, like I said, that gold is probably going to outperform here for the next couple of weeks. Moving over here to stocks above the 50-day and 200-day averages, you can see the 50-day came into this level, found some support, threw a wick to the upside at that next level, looking to see a push above this level. If that does happen, then we could see a couple of weeks of bullish price action. Doesn't necessarily mean that we're going to get all the way back up to this more healthy level, but we could certainly see a little bit of a bounce. You can see multiple times we've come into this zone. Looking at May from last year, came into zone, found support, had a really bullish week into the next week before we found resistance at the 42.40 level. And then we broke down really substantially, creating that deeper low here before we had a more substantial bounce. Similarly here on the 200-day average, you can see what that looked like. Found some support here at the 36.23 level. We do have a candle of indecision here, and it does look weak on the indicators. RSI and MACD on both charts look pretty weak. But like I said before, we have found support at this zone. Wicks to the downside, held in the zone, threw a big wick to the upside, and then we got the continuation down. So overall, the trend still seems to be down, but it doesn't mean that we can't get a shorter term reversal here, maybe up to the next resistance at 52.37. That would be interesting. And then if we did get up to that level, I certainly would expect to find some resistance and then potentially a push back down to where we are right now. If we find a bounce there, then you have a double bottom and a potential for higher prices. But if we do break down, then we're looking much lower down at 24.25, where we have substantial bottoms and tops through last year. Like I said, I do want to highlight RSI here on the 200 average is very weak, pretty extended from the SMA. So generally when we get this far, we do get a little bit of a pullback like we did here on the rally. So we could see that pullback before we get rejection and a bigger push lower. Moving over to the normal charts here on the weekly, you can see Apple still looks strong, closing pretty much at this high resistance. MACD looks strong, RSI looks strong, looking to push to that upper level at 161 at the major downtrend line. Certainly could throw a wick to this upper level like we talked about at 163. When you have two levels very close together, you would expect a wick through that upper level. Looking at volume, that makes sense. That area of higher volume is at 163 as well. So it would make sense to throw a wick there. Looking at Tesla, much weaker. MACD stepping down. RSI still looks okay, but this looks more like a pullback to resistance up around 93.50, the level we've been watching, where I would expect to find some resistance, and then maybe we double bottom back down at 165. And then if you look at the daily chart, there's some gaps in this really big push that we had sitting down around 145. Maybe we come down, fill that gap, and then get a more substantial push higher. That would be interesting. But right now, this looks like a shorter term pullback on Tesla. Looking at staples versus discretionary on the weekly view, you can see staples continues to hold this level. As long as that continues to hold here, you can be bullish. We also have the 144 EMA sit just below it. We could go to that level and then get a more substantial bounce. That would be interesting. If that breaks down, then we're looking all the way down at 67.70, down at the 200 SMA. If we do get a more substantial bounce, then we're looking at 76 to the upside here on the weekly chart. Similarly, here on discretionary, we're kind of holding with this zone. We've been here for many months at this point, going all the way back to May of last year. We also have an area of highest volume just to our downside, sitting at 140. If this rally continues, I would look for pushback into this zone at 148, 149. That would be interesting. At that point, I would expect resistance here from the 200 SMA and 55-week moving average before we would get a bigger push down back probably to this most recent low right around 127, 128. So overall, still bearish on the discretionary, but maybe short-term bullish over the next week or two until we retest those levels. MACD still stepping down. MACD on staples looks stronger. RSI on staples has a little bit of upside before it's bullish. RSI slight bullish just above the SMA here. Huge volume stepping up over the last week, with the strongest volume being on that bullish candle. So interesting. Watch that going into the next week. If we see a really strong push, maybe we need to look for a little bit higher prices up around 163. That would be interesting. We have to watch this first level of resistance. Moving over to the dollar here on the weekly view, you can see we threw a wick to the downside to the 9-week moving average at 103.63, found some support at that level, and now we're bouncing a little bit higher, found rejection at the 55 and 21 EMAs here. So we're stuck between these levels, continuing to chop between. We've talked about that multiple times. Lots of strong support and resistance in this zone. If rates continue lower, we could see the dollar start to fall off, moving back down to this 101.80, 101.90 level back at these previous lows. That would be bullish for stocks, and it does certainly seem possible here. It's worth noting that we did just get slightly bullish momentum after a pretty substantial step down here on the MACD. RSI is weakening, and you can see we have a pretty substantial step down even to that most recent low. And then it does seem like we could go a little bit lower before we interact with the SMA. Then we'll have to watch to see if we get an SMA bounce from there. Maybe it's a short-term bounce, find resistance again, and then we go lower to that deeper support level. But right now, the dollar looks a little bit weaker in my opinion. Moving over here to JNK, you can see we threw another doji. We have a wick to the upside and to the downside. Momentum still bearish. RSI is still bearish. We do have some lower lows of support here. We're still above the 89 level. We're also right at the lows here going back to June. If this 89 level breaks down, we're looking at these next lows down here at 87.50 or the wicks down here at 86.35. Zooming out just a little bit, if that level does break down, then we're going to be looking to this next lowest level down at 84.50. That would be pretty substantial. Zooming out here some more, you can see that's right in great financial crisis levels here on JNK. I don't think we're going to be going down quite that low. And if we do see a bit of a bounce here, JNK kind of moves sideways within this zone, allowing that 55 EMA to come in flat, and then we can get above the 55 EMA and move slightly higher to retest the 144 and 200 SMA. That should be pretty bearish generally for markets. So keep an eye on this. Probably going to chop sideways, allow these EMAs to flatten out and look to turn bullish. But if we do break this 89 level, then we have a little bit of downside. And if these lows break down, then we have significant downside. So keep an eye on this. Still at a critical level, still have a candle of indecision on the weekly, but does look slightly bearish in the short term. Finishing up with the charts here with the VIX, you can see here we threw wicks to that upper trend line, which has been holding for multiple moves here. Overthrew it a little bit in October before getting that more substantial move down. 2 wicks to that level does still seem like we're going higher. MACD and RSI are both bullish. But as long as we don't get above this level, I don't see any new substantial lows happening. If we do get above and hold, like we did here previously, going back to the move on the COVID dip, that would be interesting. And like I said, that would mean much more substantial lows. We had this gradual increase for a while. That doesn't seem to be happening now. Do have a little bit of a shift here where we have a low and higher low. We've talked about that before. But until this really gets above here and holds, I don't expect a major move down in the short term. We continue to find rejection. We continue to find buyers. Lots of volume coming into the markets right now. So as long as tech is continuing to outperform, I don't think we're going to see major lows. Of course, big tech is not as substantial in the Russell 2000. So the Russell 2000 could still go lower. But as long as tech is rallying, I don't see the S&Ps or the NASDAQ making new lows. Moving over to my positions here on the IWM and the Qs, you can see I am holding this IWM position. If it breaks below this 170 level, I plan to be out here, and then I'll look for that more substantial bounce. Right now, it's still consolidating, still holding, so I'll hold this position. If we can close above 173, I'll definitely let that option get executed and get out of these shares. I'll probably look to get some puts here in the NASDAQ on my IRA account. I can't hold a full 100 shares of the Qs in this account just due to the amount of capital I have in here. But I do think tech is going to continue their rally. And like you can see here, I do have covered calls here at 301. I might continue to roll these out, or I might let them get executed and start putting in some new puts to get a little bit more credit here on a NASDAQ position. So I'll keep that in mind. Right now, I have a big credit here, $5 on these calls. So my upside is 306 and my downside is all the way down to 296. So in a pretty protected position here. Of course, remember we have the FOMC on the 22nd. So the day after these calls, if I do plan to roll out these calls, I might roll past the FOMC just to get a little bit more protection depending on what we see there. If they do the 25 basis points, I do expect markets to suffer a little bit just because we know that if 25 basis points happens, that's going to affect the banking crisis a little bit more substantially. And there's certainly limits to what the Fed can continue to backstop with these regional banks. So keep that in mind, watching IWM closely, looking for that breakdown. If it holds, then we can continue to trade a position like this, and then continuing to look at a NASDAQ position potentially after the FOMC and allowing this covered call to get executed. Let me know down in the comments section what you thought of all these charts. Lots and lots of content in this video, all very important in my opinion. Let me know your thoughts down in the comments section. If you could help me get to 1K subscribers, that would be awesome. Definitely like and subscribe if you got any value out of this video. Make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.